Today is the 16th of May 2022. My name is David Hickson, and in today's market update we're going to be taking a look at several markets that are all forming troughs at the moment. However, they are all also in a fairly bearish situation. Before we take a look at those markets, I must ask you to make sure that you have read and understood these disclaimers. Let's start with a quick look at the S&P 500, and I have zoomed out a little bit here so that you can see the big trough here in March of 2020, the trough that I sometimes refer to as the pandemic trough, because there is the possibility that some of the anxiety that was sweeping around the world at the time caused a distorted trough at that time. However, you will see that this analysis positions the really big 54-month, or in this case the 9-year cycle trough at that position. As you might know, if you've watched several of these market update videos, I don't worry too much about the exact details of the position of the longer cycles, because I am generally, in these market update videos at any rate, looking at what we are expecting to happen over the next few weeks. So that's the time frame that we're focusing on. It is possible that the trough in March of 2020 was of 9-year magnitude. It is most probably a trough of 54-month magnitude. And you will know, if you've watched previous market update videos, in terms of the discussion that I've presented with the Nasdaq, it is possible that the March 2020 trough was of only 18-month magnitude, distorted to the downside in most markets because of the anxiety, the pandemic anxiety that was spreading around the world and perhaps causing a distortion in the markets. I've discussed all of that in previous market update videos, so I would encourage you to take a look at those videos if you haven't already, if you would like to get up to speed with those ideas. The important thing, of course, is that the market has been coming down, and it is expected to have formed an 80-day cycle trough. I'm going to zoom in a moment, and we're going to discuss that in more detail. The thing I'd like to point out here is that the 18-month cycle trough, according to this analysis, is positioned at the beginning of October. I wanted to point that out because when we take a look at the other markets, you will notice that that is a point of difference between the analysis that we are considering in those various markets. The interesting thing about this analysis, of course, that I have also discussed in previous market update videos, is that we saw a very bullish 18-month cycle into this potential 18-month cycle trough in October of last year. And what has ensued since then has, of course, been a fairly bearish cycle shape or bearish market action. And if this is only the second 18-month cycle in the current 54-month cycle, then we would not have expected the market to turn quite so bearish quite so early, which again calls into question the magnitude of this cycle trough in March of 2020. But we're not going to be discussing that in today's video. I've spent a lot of time discussing it in previous market updates. What I'm going to be doing now is zooming in and considering what has been happening recently. Now, as discussed previously, the exact position of the 20-week cycle that formed either at the end of February or in early March is a little difficult to determine because we have those three likely candidates for the exact position of that cycle trough in the price action, certainly when it comes to the S&P 500. As mentioned before, I believe that this trough here on the 8th of March provides the best actual position for that 20-week cycle trough. And the reason for that, again, comes from the principle of commonality, which tells us that all markets move with a great deal in common, and that particular date was an important date in other markets. And so you can see that in this analysis, I have actually influenced the analysis. That's what this pin symbol means. I have pinned that 20-week cycle trough to the price low of the 8th of March. If I clear those marks, you will see that in fact there was a lower price over here on the 24th of February, and if I let Sentient Trader just do its own thing, it would prefer to position that 20-week cycle trough over there. It is quite possible that the 20-week cycle trough should be positioned there, but just out of interest, I have pinned the 20-week cycle trough to the 8th of March, and you can see that as a result of having pinned that 20-week cycle trough there, Sentient Trader has in fact already confirmed the 80-day cycle trough as having occurred last week. That is a fairly premature placement of that trough marker, in my opinion, and there are various reasons why Sentient Trader will sometimes position a trough market prematurely. Sentient Trader performs an analysis based on the process explained by Hurst in his cycles course. The first part of that analysis involves a form of spectral analysis, but the more important part of the analysis process has to do with pattern recognition, which is effectively what Hurst was presenting in his cycles course. And it also has to do with things such as VTLs and FLDs being crossed by price. Those cycle tools provide us with confirmation that a trough or a peak has formed in the market. I won't go into too much detail here because I could speak about it for hours, but it is important to realize that the fact that Sentient Trader has positioned that 80-day cycle trough over there does not mean that it is absolutely confirmed. It is a hollow trough, as you can see. In other words, the diamonds are not filled in, which means that even according to Sentient Trader, it is not absolutely confirmed, but it is likely. And one of the things that Sentient Trader does is it measures the speed of the bounce out of the trough, and it quite liked the speed that it saw on Friday of last week. But the fact that Sentient Trader has positioned the diamonds there does not mean that it is absolutely certain. And that is the first really important point that I want to make in today's video, is that because Sentient Trader, or you as the analyst, actually position a diamond beneath a trough does not mean that it is 100% certain that that trough is formed. So what do we need to see happen at this point? Let's zoom in and consider it in a little more detail. When price comes down to form a trough, we are looking for confirmation, and the way in which we get confirmation that that trough has formed is by taking a look at our cycle tools. Let's consider first the VTL. I don't very often speak about the VTL. The VTL can be a little bit unreliable because it is very closely based upon the analysis, and so the FLD is the more useful tool in my opinion. But when price crosses a VTL, it does confirm that a trough of a cycle 1 degree greater than the magnitude of the VTL that has been crossed has formed in the markets. In other words, here is a 20-day cycle VTL. When or if price crosses above this 20-day cycle VTL, we would have confirmation that a 40-day cycle trough is formed in the markets. And of course, because of the principle of synchronicity, we will know that that trough is of 80-day magnitude. Now, here is a 5-day cycle VTL. When price crossed above that 5-day cycle VTL on Friday, it gave us confirmation that a 10-day cycle trough had formed in the markets. Again, because of the principle of synchronicity, Sentient Trader has stacked up the diamonds, and getting confirmation that that is a 10-day cycle trough that has formed, it uses the principle of synchronicity to assume then that the 20-day, 40-day and 80-day cycle troughs have formed. Although, as I've mentioned, that is a premature assumption. The other cycle tool is one that you are probably more familiar with, which is the FLD. When price crosses above the 20-day FLD, or I should say if it crosses above the 20-day FLD, it will give us confirmation that a 20-day cycle trough is formed in the markets. Because of the sequence of interactions that we track, we will have confidence that when price crosses above the 20-day FLD, that cycle trough that is formed will be of greater magnitude, probably 80-day magnitude. But there are also, of course, shorter FLDs, because there is an FLD for each and every cycle. And you will see here that the 10-day FLD has been reached in pre-market trading. I'm recording this video before the US markets open. And it looks as if the price might have found some resistance at the level of the 10-day FLD, but if it does cross above that FLD, it will confirm that a 10-day cycle trough has formed. The 5-day cycle FLD was reached on Friday, and it was effectively crossed over the weekend, at least median price crossed over the weekend. And so that confirms that the trough is of at least 5-day magnitude, which is not particularly helpful in this situation. But now let's zoom out and ask ourselves what it means that price is forming an 80-day cycle trough in the markets. Some people who are new to Hurst cycles assume that that means the price is going to bounce up for about 40 days, that's half the 80-day cycle, and then down for about 40 days for the remainder of the 80-day cycle. However, that is not true. It is very important to bear in mind what the other cycles are doing, particularly the longer cycles, to influence the shape of this 80-day cycle. Here is an example. The previous 80-day cycle, let me just clear that, went like this. It rose up to an early peak, which is a bearish indication. Remember that an early peak signifies a bearish cycle shape. And then, of course, it ended its 80-day cycle. Whether it ended it last week or whether it's still going to extend a little bit lower, it has ended it below the level at which it started. And so that is clearly a bearish cycle. What are we expecting from the next 80-day cycle? Is it going to be the same bearishness, more bearish, or less bearish? Or is it possibly going to be a bullish cycle? That is determined by the other cycles and their positions in the analysis. And as you can see, we have a nest of lows for a 40-week cycle trough over here at the end of July. And so this next 80-day cycle must bring us down into that 40-week cycle trough. And we are expecting a more bearish 80-day cycle to bring us into that 40-week cycle trough. Here, these semicircles can be useful in understanding what the longer cycles are doing. Here is the cyan-colored 80-day cycle, which is expected to cause price to bounce a little bit upwards and then bring it back downwards, of course. However, the longer cycles paint a bearish picture. The 20-day cycle, as you can see from this semicircle, is pressing downwards. And the 40-week cycle is also pressing downwards fairly strongly to bring price into this 40-week cycle trough. You will notice that this circle for the 40-week cycle is a bit displaced to the left. The reason for that is because these circles are plotted on the basis of the recent wavelengths of the cycle in question. And so we are looking fairly far back in the past to calculate the recent average length of this 40-week cycle. And all cycles shorter than the 40-week cycle seem to have been stretching, which is why the nest of lows for those synchronized cycles is further to the right on our chart. You will also notice, if I clear those markings, that the whisker to the left-hand edge of this 40-week cycle does encompass last week's price action. This means that it is just possible that the 40-week cycle trough formed last week, and that this is not an 80-day cycle trough, but a 40-week cycle trough. The analysis that we've been looking at and considering every single week for many months is a very good analysis in my opinion, and I do think there is another 80-day cycle to go until we reach this 40-week cycle trough. But it is certainly something to bear in the back of our minds as we see price rising out of this potential trough and confirming as it does what the magnitude of that trough is. So now, if we are expecting a more bearish cycle over the next 80 days, then what is that likely to look like? Well, the composite model line gives us a fairly good way of visualizing the implications of the analysis, and it does a very good job in this particular situation. It takes the cycle information from the analysis at the foot of the chart, it recombines it to present to us in the past what would have happened to price if the only thing influencing that price had been the cycles as found in the analysis. It then extends that information into the future, and it assumes that the cycles keep beating with the same wavelength and the same amplitude, and it plots the price action that we could expect in that situation. As you can see, it is projecting a bearish cycle to bring us into a lower cycle trough towards the end of July, which would be a 40-week cycle trough according to this analysis. And so the fact that the market might have formed an 80-day cycle trough is probably not a very bullish thing. Sometimes when I speak about an 80-day cycle trough forming, people assume that means I'm going to be bullish for many weeks. But that is certainly not the case in this situation. I think that the markets are fairly bearish, as discussed in previous market update videos. I thought it would be interesting to look at the FTSE 100 from the UK. It's been some time since I last looked at the FTSE, and the analysis in the FTSE can sometimes be a little bit tricky, but I think it does provide us with some interesting information on the current situation in the market. Here is the longer term picture with a 9-year cycle trough in 2009. Another 9-year cycle trough in 2016, the 54-month cycle trough over here in March of 2020, although again that might have been a slightly distorted trough because of the pandemic. But the interesting information that it can provide us with comes after that time, of course. Here is the analysis. You can see that I have influenced it slightly, and I have pinned this 18-month cycle trough over here to September of last year. The interesting thing about the British market is that it has stayed more buoyant than the US markets. It hasn't turned down nearly as strongly. And so we had a good bullish 18-month cycle that elapsed into September of last year. And now we have seen an interesting cycle shape developing. Let's zoom in and take a look. Let's consider the shape of the 20-week cycle. Here is the M shape with the midpoint of the M at the 80-day cycle trough. So you can see it is an expanding cycle shape. It is not in fact a bearish cycle shape because it has a late peak. And although the trough occurred over here in the second week of March, ever so slightly lower than the trough in September, it was only slightly lower, and so it presents us with a mixed cycle shape or a neutral cycle shape. It is really interesting to see the symmetry that has developed since then, with the market bouncing out of that 20-week cycle trough in almost perfect symmetry with the fall down that preceded that 20-week cycle trough. Price has now come down to the 80-day cycle trough, which, as you can see, Sentient Trader has positioned as forming last week. That makes a very reasonable position for that 80-day cycle trough. And so here again, we are expecting a bounce out of the 80-day cycle trough. But then, of course, the markets are going to turn down and come down into this 40-week cycle trough expected towards the end of July. Notice again the displaced 40-week cycle circle. Again, we need to consider the possibility that the trough that has just formed could be of 40-week magnitude, and that the analysis of the shorter cycles, the 20-week and the 80-day and so forth, is actually incorrect as presented on this chart. We can keep that idea in the back of our minds, but I tend to agree with this analysis and believe that the 40-week cycle trough is only expected towards the end of July or possibly even early August. The interesting thing about this composite model line, when I display it on the chart, is that it is not expecting quite such a turn to a bearish market in the UK. So it looks as if the UK might fare better over the next few months. However, certainly we are going to get a bounce out of this 80-day cycle trough, and then of course we're going to experience a downward move into this 40-week cycle trough. Now the interesting thing about this is that usually a 40-week cycle trough is expected to be lower than the 20-week cycle trough that precedes it in a neutral market. And I've mentioned that the 20-week cycle was fairly neutral. So until we have evidence to the contrary, this is turning out to be, so far, a fairly neutral market. Therefore, I would not take the level of the composite model line too seriously. I would be looking at the market coming further down. And because of the bearishness that we're seeing in the US markets, I wouldn't be surprised to see the British markets also losing some ground as they move into that 40-week cycle trough. We often get requests to discuss the Nifty 50 from India, and I do every few weeks try to include it in the market update videos. So here's an update on the Nifty 50. I thought I would demonstrate something interesting about this analysis. Markets in different countries sometimes require different cycles in order to analyze them. That's because Hurst, when he originally defined his nominal model, was working with US stocks. And he was fairly careful to say that his work had been done on US stocks and that the cycles he was speaking about were the cycles that had been found to influence the stocks of companies in the United States. It is possible that different cycles influence different markets. However, I have to say that after many years of doing this, I do believe that the cycles generally tend to average out to being very close to one another. But in Sentient Trader, you can perform an analysis using what is called the initial cyclic model. I won't spend too long explaining it here, but Hurst actually recommended that one of the approaches you could take to your analysis would be to give greater emphasis to the results of the spectral analysis that is performed on the data, because the spectral analysis reveals possible cycles that are currently influencing the markets. He recommended creating something he called an initial cyclic model, which is simply a list of cycles, just as the nominal model is. In Sentient Trader, you can ask the software to generate the initial cyclic model and then to perform an analysis on the basis of that initial cyclic model, which means you can come up with some fairly different cycle wavelengths, which might match the price action a little better than the default nominal model, which was discovered by Hurst, of course, 50 years ago on the basis of US stocks. So this analysis is based on the initial cyclic model. And if you take a look at the cycle wavelengths down here at the bottom right-hand corner of the chart, you will see that the cycle wavelengths do differ from Hurst's nominal model. For instance, the 18-month cycle is only a little over 15 months, and the 40-week cycle is in fact a 30-week cycle, the 20-week cycle, a 16-week cycle, and so forth. I find this a very interesting analysis of the Nifty 50. What it does do is it presents an 18-month cycle trough over here in April of last year. It then finds a 40-week cycle trough in December of last year. An 80-day cycle trough was the magnitude of the trough at the beginning of March, which of course we've been considering as a 20-week cycle trough in the other markets. The principle of commonality doesn't require that the cycle magnitudes are absolutely the same. And so you will often find in different countries that where in one country you have a 20-week cycle trough, in another country it might be only 80 days, or it might be a 40-week cycle trough. Of course, the implications of this analysis are that the trough that we are expecting to form now is of 20-week magnitude, as you can see from this nest of lows. What I particularly like about this analysis is the very clear cycle movement that we have seen recently in that M shape over there, following the trough that has been phased as a 40-week cycle trough in this analysis. Let's zoom in and consider that in a little more detail. Here you can see the 40-week cycle trough and a very nice clean cycle that developed into the 80-day cycle trough at the beginning of March. That, you can see, was a bearish cycle with an early peak and a much lower finishing trough or closing trough where the cycle ended. We would then expect a more bearish cycle for the next 80-day cycle, bringing us into the 20-week cycle trough, which is expected to form round about now. As you can see, last week there wasn't a strong move up as there was in the US markets, and so there is no evidence that that trough has formed yet, but we are certainly expecting the 20-week cycle trough to form. You can see that the number of days that have elapsed since the 40-week cycle trough in December of last year is 147 days, which is 21 weeks. I've just pointed out that this analysis is based upon cycles that have an average length that is shorter than the standard nominal model that Hurst discovered. But the principle of variation is alive and well in every single one of the markets that we analyze, and so it is quite possible that this 20-week cycle has stretched longer than the average found in our initial spectral analysis process. Again, the composite model line gives us useful information in terms of what we could expect. You can see that it matches the price action fairly well, although it would have expected the price action to have been slightly more bullish than it actually was. You can see the composite model line has a low at the 40-week cycle trough that is lower than where it is expecting the 20-week cycle trough to form. Nevertheless, the next 80-day cycle or 20-week cycle for the Nifty is expected to be a fairly bearish cycle, bringing prices down into new lows towards the end of August. This is the other analysis that I'm watching in the Nifty, where I am applying Hurst's nominal model. In other words, I'm applying the list of cycles that he discovered 50 years ago based on his analysis in the US markets. The interesting thing is that this is an equally good analysis, possibly a better analysis. You can see I have influenced it slightly by phasing the 18-month cycle trough over here at the trough in December. This gives us a very good regular analysis, which is often a sign of a good analysis, but of course it doesn't necessarily mean that it is a better analysis. The important thing is that in terms of what is happening now, there is not very much difference. If we zoom in, you can see that we have an 18-month cycle trough over here in December of last year, as opposed to the 40-week cycle trough that was found in the other analysis. We have the same position for the 80-day cycle trough, and here is a very neat nest of lows projecting that the 20-week cycle trough is going to be due next week. Of course, it is quite possible that that trough might have formed last week, although it looks as if the pre-market price action has brought price down to the same levels as last week. Nevertheless, the point is that we are expecting a 20-week cycle trough to form within the next week or two. Then there is a very neat nest of lows for the 80-day cycle trough, and here is the 40-week cycle trough that we've been identifying in the other markets. The difference being that in the Nifty it is only expected in late October or early November. But now there is an interesting anomaly that has developed in this analysis, which is that the market has been more bearish than it should have been following the formation of an 18-month cycle trough. That is clearly visible when we present the composite model line. The composite model line, as you can see, has been expecting a fairly bullish cycle shape to have elapsed, whereas what price action has done is presented a bearish price action. This is an anomaly that really causes me to question this analysis and to question whether the 18-month cycle trough really did form in December of last year. Is there a reasonable explanation? Well, there could be. That reasonable explanation, and it is perhaps not quite as reasonable as I might imply, because I'm sure this will ruffle a few feathers, but the possible explanation is again to do with the possible distortion of the cycle picture because of the pandemic. This very strong move down, bringing us into a 54-month cycle trough, could be called into question. Is it possible that, as discussed when we look at the Nasdaq, the important trough should really be positioned over here in 2018? That would mean that we have seen 1, 2, and we are now in our third 18-month cycle. The third 18-month cycle is expected to be the most bearish of all the 18-month cycles. Now let's take a quick look at Bitcoin. And the previous time I spoke about Bitcoin, I mentioned that I expected it to form a peak in early April. I think that peak was in the last day or two of March, so that peak came in just a few days early, and that was, of course, a 20-week cycle peak. I then mentioned the price was going to, of course, drop down and form a trough, and then come back up and form a peak in about July. The price of Bitcoin has come down fairly sharply over the past few weeks, and as you can see, it looks as if it is approaching or is in the process of forming a 40-week cycle trough. Now, there have been 300 days or 42.9 weeks since the 18-month cycle trough in July of last year, according to this analysis. As mentioned in my previous updates about Bitcoin, I'm finding the peak analysis much more reliable at the moment than the trough analysis. And so I'm not paying very much attention to the trough analysis, but it is useful just to keep an eye on it. Some of the problems that have occurred recently in the trough analysis are this very strange position of the 20-week cycle trough over here. I shouldn't say strange position, but the price action surrounding that 20-week cycle trough consisted of one strong move down with an immediate bounce back up again, only a few days of recovery following it, and then of course price action continued unfolding, and so that's not really a very good position for a cycle trough. We also have this trough over here in January of this year, which you can see, according to this analysis, doesn't even appear in the phasing. That's a really big question mark. This trough of the 80-day cycle is a fairly reasonable trough towards the end of February, but there are nevertheless many questions surrounding the trough analysis. One of the useful features of having both a trough analysis and a peak analysis, as I presented in last week's update, is the zigzag tool that you can use. One of the comments on YouTube was to please show the zigzags on Bitcoin. So here they are. These are the zigzags for the 20-week cycle and for the 40-week cycle. You can see that at the moment they're not presenting us with very much useful information because the zigzag tool has actually decided that the 20-week cycle and the 40-week cycle have formed their trough. Now that makes for an interesting point of discussion. Why has the zigzag tool decided that those troughs have formed? However, the trough is not marked yet on the analysis. There are no diamonds under there. The reason is very simple. The targets as generated by the zigzag tool have been fulfilled. You might remember that in last week's update I presented the manner in which these targets are calculated with a line that extends. I've drawn a rather rough line, but you get the idea. A line that extends from the start of the zigzag pattern through the center of the crossing line and then down to the end point. The targets initially start off as these wide circles. That's because in the next part of the zigzag pattern, we are expecting a three-legged price move up to this peak over here in July. And the reason why these circles are so wide is because there is very little price action. In fact, only a few days worth of price action to actually construct the zigzag. So it starts with a really wide circle. And then as the price action unfolds, and we establish, first of all, the initial peak over there, and then we construct the downward line and form this trough over here, which will probably be in line with the 80-day cycle trough. That target circle will be refined because of the fact that we can plot it more accurately. It is interesting to note, however, that the zigzag tool is already looking ahead at the next part of the pattern, which means that we can expect price to bounce up and move towards the peak, expected still towards the end of July. But of course, as mentioned when discussing the price action in the S&P 500, we need to keep an eye on our cycle tools for confirmation that that trough has formed. If we take a look at the shorter cycle FLDs, here is the 10-day FLD. Price has come up to the 10-day FLD but found resistance there. It hasn't yet crossed it. We do not yet have confirmation that this is a trough of even 10-day magnitude. And so it is quite possible that price could continue further down, but we are on the lookout for the formation of the 40-week cycle trough here. As a matter of interest, if you calculate the target generated by price crossing this 20-week FLD, after dropping from this peak over here and finally crossing at this level over there, that target was at about a level of 28,000. But of course, the fact that the target of an FLD projection has been reached does not necessarily mean that the move is over. It is only one of the indications that we look for when watching for a major trough to form in the market. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.